Hey guys, what's up? I'm Erin and welcome back to the channel. How much do you think you need to retire? $1 million, maybe $2 million? Well, according to Northwestern Mutual, the magic number that most Americans feel they need is $1.46 million. And if you guessed that exact number, congratulations. Here's the thing, that number doesn't really surprise me all that much. People are living longer in retirement, healthcare costs are increasing, inflationary pressures are there, and when it comes to our portfolios, we're only supposed to be using a modest, safe rate of withdrawal. But what I do find surprising is how quickly these numbers are increasing from year to year. Just 5 years ago, that number was about $950,000, and then slowly but surely it ticked upward to where it currently sits today at $1.46 million. In the past year alone, the portfolio needed for a secure retirement increased by about 15%. Throughout the past 5 years, it's increased by nearly 54%. These are pretty darn aggressive jumps, and I think that's a reflection of the uncertainties we face in the economy today, as well as the 20 or 30 or perhaps even 40 years of uncertainties that we would face in retirement. So when in doubt, the answer just seems to be more. Realistically, expecting a 15% rate of return in the long term is probably not likely. But for the sake of argument, let's look at what it might take to hit this $1.46 million by the time you retire. And according to this survey from Northwestern Mutual, most people are targeting to retire at the age of 65. So that's going to be our benchmark. Well, if you started at the age of 20 and assume a 6% annual rate of return, you would need to save $572 per month. Assuming a rate of return of 8%, you would need to save $315 per month. And assuming a 10% rate of return, you would need to save just $170 a month in order to hit this target of $1.46 million. If you were to start saving at the age of 30, you would need to save anywhere from $450 per month with a 10% rate of return to nearly $1,100 per month with a 6% rate of return. And finally, if you were to start at the age of 40, you would need to save about $1,200 a month to $2,200 a month, depending on your expected rate of return, in order to hit this target at the age of 65. As always, the earlier you start, the easier it's going to be to hit any level of wealth. This is going to be true no matter what. So the good general rule of thumb is to start early and save and invest often, and your future self will thank you for it. When we run these hypothetical models, they're just that, hypothetical, because we can't predict what the market's going to do from one year to the next, and let alone for the next 20 or 30 or 40 years. We're kind of just left doing our best guess, and the best guess is still to save early and save often. Your future self will still thank you, so that previous statement still rings true. But what if we went back in time to see how the market actually performed for someone who is retiring today at the age of 65 with this $1.46 million invested? How much would they have had to invest based on actual market performance if they had started investing at the age of 20 or 30 or 40? Based on how the S&P performed, if we had an investor start in 1979, they would have needed to invest just $195 a month to retire with a $1.46 million portfolio today in 2025. For the investor starting in 1989, they would have had to invest $532 per month. And the investor starting in 1999, they would have needed to invest $1,257 per month. I think one really notable thing is that if we look at each of these investment amounts, they line up pretty nicely with the estimated amount assuming a 10% rate of return, and that can be pretty encouraging. And while the S&P has historically given us a 10% annualized rate of return, that's not what it does every single year. Some decades we have very robust growth, and then we have periods of extended downturns. That's why it's important to plan for a variety of outcomes. And let's not forget that $195 back in 1979 is very different than $195 today in 2025. So once we adjust those numbers up for inflation, they feel like a lot more. $195 back in 1979 is more like investing $737 per month today. $532 in 1989, well, that's like investing $1,500 a month today. And $1,200 back in 1999 is more like $2,600 today. And if we go back and we look at the median household income for those respective time frames and then consider the savings rate needed to hit these respective benchmarks, we see that for the individual who started at the age of 20, they would need a savings rate of about 14% if they had the median household income at the time. For the individual starting at the age of 30, they would have needed about a 22% savings rate. And for the individual starting in 1999, they would have needed about a 37% savings rate. Again, none of this is really surprising. The earlier you start, the less you need to save in order to hit this goal because you have a longer runway. The later you start, the more you need to save in order to catch up and hit the same lofty goal. Rather than just a number as an aimless target, a better bet is to figure out what your expenses are in retirement. Then, once you know your expenses, you can go ahead and figure out what size portfolio you really need to fund the lifestyle you want. So, do today's retirees really need $1.46 million in order to retire well? Well, let's look at some data. According to the Social Security Administration, for Americans 65 and older, the median household spending is about $64,000 per year, with only 12% of households spending more than $75,000 per year. These are very realistic numbers, and it gives us a good starting point. Now, your number is likely to vary because it's going to depend on where you live and your lifestyle, but this does give us a good starting point. Let's use that median figure, but let's make it an even $65,000 a year because that, quite frankly, is an easier number to work with. This would mean that our household would need about $5,400 per month. And if you were to use that investment portfolio of $1.46 million and a safe rate of withdrawal of 4%, this would give us an annual income of $58,400. And unfortunately, this does have us running a little bit shy of that median figure of $65,000 a year. But that doesn't tell the whole story, because the fact of the matter is the vast majority of Americans, at least 90% or more, do receive Social Security benefits. The average Social Security check at the age of 65, that's $1,500. And if we have a two-person household and they're each receiving this Social Security benefit, the household is bringing in $3,000 a month just from Social Security benefits alone. Meaning that our retired household would only have a gap of $2,400 a month needed to fill from their investments. In order to fill that gap, assuming a 4% safe rate of withdrawal, this set of retirees would need an investment portfolio of $720,000. This is still a very significant investment portfolio, but it's only half of what's suggested as needed by the Northwestern Mutual study. So I think this goes a long way to show that you can very well have a successful retirement on a much lesser portfolio depending on your lifestyle. If your Social Security benefits are lower, you may need a larger investment portfolio to cover your expenses. Conversely, a higher Social Security income reduces the amount you may need to save. The reality is that lower lifetime earnings translates to a lower Social Security benefit payout, which probably meant it was harder to build wealth throughout your working careers. On the other hand, a higher lifetime earnings will translate to a higher Social Security payout, but it also probably means that it was easier for you to save and invest and build wealth throughout your working careers. It's unfortunate, but a natural cycle. If we look at the average Social Security check of someone claiming at the age of 62, that check is closer to $1,200 a month. For a couple, each receiving the same benefit, they would have a $3,000 gap to fill from investments. This might mean that they would need a $900,000 investment portfolio. And what about those couples who delay claiming until the age of 70? The average Social Security check at this point is $2,000 per month. And for a household with two individuals earning this amount, now they would only have a gap of $1,400 a month, meaning they might only need $420,000 in investments. Retirement surveys really do tend to overestimate this magic number when it comes to retirement, because when people are asked how much do they think they need to retire, they're going to factor in a lot of uncertainties and they're going to aim high in order to feel secure. Practically every survey out there is going to say that you need $1 million or more saved up in order to have a successful retirement. But keep in mind that 90% of people retiring today do not have $1 million saved up. And still, the vast majority of them feel like they have a successful retirement. So what it comes down to is planning what your actual expenses are, factor in Social Security, and make sure you have enough to fill that gap and base it on your lifestyle, not some survey. So what is your target? How much do you think you need to retire comfortably after you factor in Social Security? Leave your thoughts in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. Shouldn't cross my legs. I'm gonna fall off when I stand up. It's very windy. Hopefully you can't hear it. Settle down. Wind. Favorite topic in the world, inflation. Let's talk about it because somebody's gonna mention it. I said 175. It's 195. That's frustrating. Big kudos, because I am not reading off a teleprompter here. So do today's I'm certain somebody who was deaf actually heard that level of noise. Mute. Why do I always forget to mute? That lighting is gonna mess with us today. Let's just all strap in because it's gonna do its thing and there's nothing we can do about it. And yes, I pronounced often with a T. Happy.